Good evening, everyone. And here we are back with another strong session on the topic of corporate and economic laws, through which we are going to cover a different topic altogether, what we have been studying so far, and taking a jump into the world of banking, recovery, defaults, NPAs, and so on. So you must be wondering that what is the need for incorporating this particular subject act under the head corporate and economic laws. Friends, because this particular act relates to the world of business, and where a lot of businesses are under the structure of companies. Therefore, it is important for all of us to understand this particular act, that is the SARFAESI Act. And along with that, we have the newly introduced act, that is IBC also. So clubbing both the acts together, the SARFAESI and the IBC, it is creating a whole new area of practice, opportunity, job, and also very much required to run a business, friends. So prepare yourself for today for another interesting session, I would say, because today you'll be learning a lot of new terms. Till now, it has been mostly the corporate world, the company laws, and the world of the SEBIs. But today it will be a different world. Therefore, you will be understanding new terms, which I think is very much required, because being a professional, I think we should be knowing all the financial jargons which applies to the corporate world, the banking world. And so please keep your eyes and ears both open, so that at least you have a basic understanding of the terms. So good evening, Chavi, and let's begin the class. If others who have joined in for the live class, can we just say good evening, and so that I can understand that who are the people who have logged in for today's class. So friends, the act itself is a very long act in terms of the name nomenclature, where it talks about three aspects to be covered under this law. So we have a securitization and reconstruction of financial assets and enforcement of security interests. Enforcement of security interests. So we have three aspects to be covered here, friends. Three aspects under one law. So the law is covering only about 30 sections, and that too under 30 sections. For us, we will be covering only till 1 to 20. That will be more than enough. So in the next 3 hours, we'll be covering these 20 sections, but covering three aspects: securitization, reconstruction of financial asset, and enforcement of security interests. Three angles. So I hope you are understanding the concept here of the name itself, nothing in relation to the words, but I hope breaking the whole act, the name of the act, into three parts. So from here only, we can understand that we'll be understanding this term securitization, we'll be understanding this term reconstruction, and we'll be understanding the term enforcement of security interest, friends. And looking to the current environment, looking to what is happening around us, this is a very common phenomena you will find in the world of banking, So let me start with the conceptual clarity of understanding what does this securitization word means. And once we understand the word securitization, Then the natural extension would follow for understanding the term reconstruction or enforcement. So the learning outcome of this particular act would be understanding the concept, then the key features of the act, obviously, and majorly the role of the banks and financial institutions in this world of SARFAESI. So if any of you are dealing in the banking world, bank audits, or have a keen interest to go in the world of finance, I think SARFAESI would be a common term used whenever you go into the world of banking and finance. So I hope you are ready with your notebook if you are sitting somewhere, and if you are traveling or not with your notebook, but then keep your notepad on your mobile phones so that you can note down the important points for review for later revision. So relatively a very new act, friends, not very old, introduced in 2002, applicable, I think it became effective in December 2002, but then it was introduced in 21st June 2002. And the purpose of the loan, very important, is to facilitate the process of liquidity recovery and reduce the burden on banks. Liquidity recovery, reduce burden on banks. So now today, we are going to understand that how to increase liquidity, especially with respect to bad loans. And this bad loan, friends, bad loans, remember, if you have read the recent budget, and during this budget also, our Honorable Finance Minister has announced something about the bad bank, bad loans. And that is also a new part in this whole process of SARFAESI insolvency. So remember, the reason is very much clear, applicable to whole of India. And mainly applicable when there is a lender institute, where there are institutions and banks, financial institutions and banks. So when these institutions are into the picture, then SARFAESI will come. Otherwise, SARFAESI will not play any role, friends. So the whole chapter, if you see the structure part, it is divided into various sections, various chapters. And we will be covering 1, 2, 3. Only 1, 2, 3. Because these are not taken in the whole course coverage for our course. So it will be 1 till 19 section. So very small, and as I mentioned in my previous lectures also, so when the act is very small, I would always suggest that you should cover this topic, because the coverage is small, and it is by default one question will be asked on this particular topic. So you are assured that by covering 19 sections, one questions will be there, and that 2 questions will be on a particular segment only, on a particular segment. Particular segment in the sense it will range either from majorly 13 to 19, or 4 to 11 section. Sumit, as I mentioned, it is financial institutions and banking wherever there's lending possibility exists. So obviously NBFC would be covered, but we'll see to it. We'll see to it, right? Let the provisions unfold and then we'll come to know about whether which part of NBFCs are covered and which are not covered if it is there in the law, right? And we all know that today NBFC play a very important role in the world of finance, giving loans. So after understanding this chapter, we will be understanding the terms of securitization. And you must be hearing this word, mortgage-backed securities. Somewhere you must have read it, especially let's say in the subject of financial management, financial services, might be. Central registry, very important if you are doing concurrent audit of banks and the season of bank audit is about to come, where most of you who are doing articleship would be going for a bank audit if allotted to a firm. This would be a common term which will be used in this bank audit. Qualified buyers, again, quite common in the newspapers, Economic Times, where the word is mentioned, QIB, qualified institutional buyers. So again, this will be a new term learned today. Security receipt, SR, in short. Word ARC, Asset Reconstruction Company Trust. Then SPV, again a common phenomena used in so many cases where companies are created for special purpose. So these are the new terms which you will understand today. And I hope with this additional gain of knowledge, you will gain more confidence, not only with respect to SARFAESI, but in general as a professional. So with this little background of the whole act, that what is in store for you, a teaser type, let's understand the process first. So once we understand the whole process, when it is crystal clear, then we'll go to the definitions and then the respective steps or the sections part. Now the process which is to be followed here. Now you should know how does a financing process happens. A financing process happens. So we have a borrower. The first need of money comes from a borrower, correct? So there's a borrower who needs money. And if he needs money, he will approach various sources of raising funds. And we know that for SARFAESI, it has to be, normally a bank has to be involved. And when you approach a bank, that means you take a loan. So when it is a borrower, obviously, we're talking about the loan part only, not the equity part. So bank will approach, the borrower will approach a bank who is known as the originator of the loan. Remember the terms, friends. Remember the terms. Originator of the loan, correct? And this bank will give loan to the borrower. This bank will give loan to the borrower. When this loan is given to the borrower, can you tell me, though it is very logical, this loan is shown in the balance sheet of the bank as what? This loan is shown in the balance sheet of the bank as what? This loan is shown in the balance sheet of the bank as what? Right. So it is shown as what? The asset, also known as financial asset. Normally it is shown as a financial asset for the bank. Correct. And for the borrower, it is a debt, financial debt. So financial asset for the bank and financial debt for the borrower. Or the bank is giving financial assistance to the borrower. It is giving some financial assistance. So financial asset to be shown in the bank's balance sheet. And normally the bank is providing financial assistance. Fine. Now, in this whole transaction, there is something else also added. The borrower has got some asset which is given as security. Which is given as security. So we mortgage our asset. We mortgage our asset. We mortgage our asset to the bank. Is it clear? We mortgage our asset as a security to the bank. Now, can you tell me who is a mortgagee and who is a mortgager? Who is a mortgagee and who is a mortgager? So I hope these terms will be very much clear. Please write it down. So mortgagee is the bank. Remember, mortgagee is the bank. And mortgager is the person who borrows. So the borrower or the mortgager mortgages his asset in the form of security to the mortgagee, that is bank. And normally this asset is in the form of what? Immovable property. Right? Now security can be in the form of two parts. Primary and collateral, if you understand the world of banking, friends. Primary and collateral. Primary asset, primary security is that security against which the loan is given. So suppose the borrower has taken a loan against plant and machinery, against land and building. So land and building and plant and machinery will be treated as a primary security. And in addition to the primary security, if the bank is asking for additional security, that is termed as collateral security, which may be given in the form of additional immovable property, which may be any other land, house, or any other structure. Right, friends? I hope this This particular process is clear till now. No confusion in this particular process. Now, what happens in due course of time? In due course of time, this loan given by the bank is first treated as performing asset, PA, performing asset. And gradually, if the borrower starts defaulting on the loan, this particular PA becomes NPA. This particular PA becomes NPA. So from performing asset, it moves to non-performing asset. Correct? Now here, the problem starts. Problem starts for whom, friends? The problem starts for the bank. Why? First, the bank does not realize his money. And if the bank does not realize his money, how it will repay to the deposit holders, or how it will give further loan. So you understand now the problem for the bank. See, the problem is the borrower is facing, that is separate. We are not concerned with that. What we are concerned with is with the problem of the bank. Remember, the bank is now facing a problem. So if everybody starts defaulting, the bank will be short of liquidity. The bank will not have funds, as it has been happening for so many public sector banks, and even some private sector banks, and even some cooperative banks, where the banks started facing the liquidity crunch because many of their financial assets moved from performing asset to non-performing asset. So now what happens here? What happens here? The ARC, a company comes into the picture. A company comes into the picture as a savior. As a savior. As a Singham. To help this bank. By providing liquidity in the form of cash. A Robin Hood kind of person. Now, when this cash is given, obviously it is not given for free. And in turn, the company ARC will ask the bank to transfer all those financial assets to the asset reconstruction company. All those financial assets to the asset reconstruction company. All those secured assets. Why secured? Because the borrower has given some security, remember. All those secured assets to the asset reconstruction company. That means The asset reconstruction company is trying to buy, the bad loans of the bank. Bad loans of the bank. Bad loans of the bank. So this cash will be given. Either the banks will issue some security, an instrument, a debenture, whatever, or any other structure against which the company will give the cash, ARC will give the cash, and all those assets will be transferred to this particular company, ARC. Now, this process of transferring the bad loans from the bank to ARC by issuing security, is known as securitization. This is one part of the whole process, friends. The term securitization of what have we done? Securitization of what? Remember, securitization of what? What was created in the books of the accounts of the bank? Securitization of financial asset. This process of transferring the bad loans from the bank to the asset reconstruction company by issuing security is known as securitization of financial asset. Is it clear, friends? So if it is clear, Sumit, we are talking of only those assets which have become non-performing. Is it clear? So I hope this process of securitization of financial asset, and it may be used as securitization of financial debt also. So you would wonder, sir, why financial debt? Because as I said, asset for the bank and debt for the borrower. So it is one and the same thing. Securitization of financial asset or financial debt. Now further, this ARC, let us understand the role of the ARC. Now, ARC will act as the asset manager. The role of the ARC would be to manage the assets. And the idea would be reconstruction of the financial asset. And the modes of restructuring could be many, which we will study, that how restructuring can be done. So there could be multiple ways of restructuring. So the role of ARC is first to act as an asset manager by reconstructing the financial asset, by selling, by changing the management, by selling some part of the business, or trying to revamp the business. There could be multiple ways. Now, when the role of ARC has been defined to become an asset manager, then how the ARC will be able to raise funds and give that money to the bank to purchase that bad loan? So in this whole process, a concept of SPV comes into the picture. SPV comes into the picture. And as the name suggests, special purpose vehicle. And in general, let me tell you, friends, for your preparation also, you need to create your special purpose vehicle designated for a specific purpose. And that to a special purpose vehicle for 7 days, 10 days, with a specific objective that in 10 days I have to cover company law, in 10 days I have to cover strategic financial management. So 10 days, special objective days have to be defined, where you have to complete the whole activity and then move on to the next one. So here also a special purpose vehicle with a specified objective is created, normally in the form of trust. That we'll understand under Section 7 of this SARFAESI Act. And this SPVs can raise funds from the market by issuing SR, security receipt, to investors, qualified institutional buyers. Will understand who are qualified institutional buyers. We'll cover that. They will issue security receipts to investors and raise funds designated for special purpose. And that funds will be used to buy the bad loans. The bad loans will be transferred to the ARC for the management. So I hope now more words in this whole process are getting incorporated. The word of SPV, the meaning of reconstruction, the concept of QIB, the concept of security receipts. Now, this security receipt can also be termed as mortgage-backed securities. Mortgage-backed securities, because these security receipts are issued with an underlying security of the asset, which was originally given by the borrower. Remember, I explained the word mortgagee and mortgager. So these are all mortgage-backed securities, where they know these securities will have certain kind of asset backing those securities. So security receipt, QIB, ARC, role of ARC, and special purpose vehicle. Any questions till this particular phase? So what type of questions will come in the exam? Let me tell you, friends, these are not part of the act. This is just trying to explain the structure, the transaction structure, that why SARFAESI came into the picture and what are the roles of different stakeholders in SARFAESI Act and what is going to happen during this process. So that now your picture is clear. You will understand the relevant sections, provisions, action steps, and so on. Any questions you can raise so that I can clarify it before we move on to the act itself. Now your question would be, sir, you should ask, are there ARC existence in India? Answer is yes. Answer is yes. There are many ARCs existing in India. If you Google it out, you will find names of few common big names where each of the big banks have their separate ARCs. Big private players also have ARCs, right? Second questions are, you might ask, so ARC is in the form of what? So ARC is a company. ARC is a company governed by RBI because it relates to financial transaction. Governed by RBI, remember. Obviously, if it is a company, the Companies Act will come into picture. But yes, governed by RBI. And SARFAESI. However, step number 5 is very much clear. The role of ARC will be to reconstruct. Now, reconstruct means by selling the bad loan, by trying to reorganize the business of that particular borrower, or by selling some of the assets of that particular borrower, business, or a part of the business, or through a merger and acquisition of that business. That is reconstruction. Once the reconstruction is done, when you have reconstructed the business, that means now the business is functioning well. And when the business starts functioning well, you are able to generate the cash from the business. That means now borrower is able to repay the loans. Borrower is able to repay the loans. So there will be cash realization from the borrower. The borrower will start repaying the loan because you have reconstructed, reorganized the whole business of the borrower. And from that cash, which is given to the SPV, what will SPV do? Remember, SPV has raised funds through QIB. Remember, SPV has raised funds through QIB. It has to repay. So that cash realized will be used to repay the security receipts. Redemption of security receipt has to be done because QIB has given certain money. It expects that money to be repaid to him. That money will be repaid out of the reconstruction done of that borrower. And once that starts yielding results from that amount, the redemption of SRs will happen. Security receipt. Weber, is it clear? The process of 5, 6, 7. Now, when SARFAESI will be invoked? When SARFAESI will be invoked? So it can be invoked when there is a debt, financial debt, right? Obviously, when there's a default. Default means NPA. When there is a financial assistance, we know we have understood the definition of financial assistance. So when there's a financial assistant or asset in the form of a debt, and the debt is a default, and default is converted into NPA, because we know that each default will not be NPA. Remember, for an NPA, we have to meet the criteria of RBI guidelines for NPA. And obviously, there has to be certain security against that loan, secured loan. That is why only secured loan will be covered under SARFAESI. So if Sumit was asking a question whether NBFC will be covered or not, friends, again, if there's unsecured loan by the NBFC, it will not be covered. So the trigger points for SARFAESI, trigger points. So these are very specific trigger points. Not in general, SARFAESI will be invoked. So if there is a performing asset, SARFAESI will never come into the picture. So if there has to be debt, so let us understand what does debt include, friends. So debt includes what is given in the definition of RDDBFI, that is debt defined as per recovery of debts due to Banks and Financial Institution Act 1993, which purely says that any amount of financial assistance given. So debt in normal parlance means any loan given by the bank or financial institution. And it is an inclusive definition, as the word says. It includes unpaid portion of the purchase price of any tangible asset given on a hire or financial lease or conditional sale or any other act. That means if any particular asset has been purchased by way of any financing technique of hire purchase or lease. So if there is any unpaid portion of that hire purchase transaction, that will also be part of the debt. So apart from any CC loan or term loan which is given, a hire purchase transaction is included, or a lease transaction is included as a part of debt. And in the same way, if it is covered for tangible asset, so it will cover for any right or title or interest on any intangible asset. So if you have paid if the bank has advanced any amount to purchase an intangible asset, and the borrower has not been able to repay that amount of money which has been taken for purchasing any right on any intangible asset, then that will also be included as a part of debt. So practically it is covering each and every transaction which could qualify as a debt. So we have understood what is debt. Now let us understand the default. Very important, friends. Very important. Please read it. One exam question has been asked from this concept. Default means non-payment of any debt or an amount payable by the borrower to any secured creditor, consequent upon which the account of such borrower is classified as NPA in the books of accounts of the secured creditor. Very important, friends. It has to be classified as an NPA. And can you tell me what is the basic criteria of classifying an account as NPA? Anybody? So Vaibhav, Sumit, and Chavi, I can see 3 people who have logged in and replying to the questions and raising query. So if they can answer, what is the basic term for being qualifying an account as an NPA account? Yes, so the first criteria is that the account should be out of order, for 90 days. Yes. Yes, Sumit, correct. So that means if there's a default happening for 90 days, you are classified as an NPA account. And the second scenario is non-payment of any debt or any other amount payable by the borrower with respect to debt securities after notice of 90 days demanding payment of dues served on such borrower by the debenture trustee. That means if the company has taken a loan in the form of debenture instruments, and if they have defaulted on repayment of the principal or the interest of that debenture instrument, then after serving a notice of 90 days demanding payment of dues, by whom? By the debenture trustee, that will be treated as default. That will be treated as default. Remember, friends, very important. That will be treated as default. So remember, if in the question the word is mentioned as unsecured, SARFAESI will never apply. Remember this point, keep it in mind, because that's a tricky part of the question where it could come in the question, a full detailed debt case study could be given, and somewhere it could be mentioned that the loan is unsecured. So just do not answer to the question. Simply write, as it is unsecured, SARFAESI would not apply. So NPA, in case of a bank, if it is administered by any regulatory authority, then whatever the directions are given by the regulatory authority, or in either case where RBI has given certain instructions. So remember, classification of NPA is a must, and a notice of 90 days is a prerequisite in case of debenture holders. These are some important things, all exam related points. Ambika, some mistake, not more than 1 year. Financial assistance, we have seen what does financial assistance means. It's a loan advance granted for any debenture or bond subscribed or any guarantee given or letters of credit established. So it can be any type of loan, right? So nothing to be explained. Purely financial assistance is loan advance given by any bank or financial institution. What does asset reconstruction means? Means acquisition by any securitization company, that is ARC, or reconstruction company. So both are the same thing. ARC either a securitization company or RC as a reconstruction company. Of any right or interest of any bank in any of the financial assistance. So whenever this happens, when you acquire certain right or interest, then you are termed as asset reconstruction. And asset reconstruction company means a company registered with RBI. So as I told you, it has to be in the form of a company registered with RBI. Remember, for general, ARC is not a banking company. That means apart from the securitization process, it cannot do any other function. That means accepting deposits, opening saving accounts, current account. That is not the job of ARC. I hope the picture is getting clear. To all of you, Ambika, Chavi, Sumit Vaibhav, that what would be the role of ARC? Now, to whom it applies? It applies to borrower. And who is a borrower? Borrower who has been granted financial assistance. Very important, friends. Remember, it applies to any person who has given any guarantee or created any mortgage or pledge as security for the financial assistance. That means if you have given a guarantee also, though you have not taken a loan, you are not the main consumer of the loan, but you have given the guarantee, you will also be falling under the net of borrower. Or if you have provided any security for the borrower, actual borrower who is using the loan, then you are also termed as borrower. And in case of default, you will always be subject to all the provisions of SARFAESI. Very important, remember this. It's not only about the borrower who has taken the loan. It's also about the guarantor who can be termed as a borrower. Right? And it includes, for exam purpose, obviously these are the two people, and also remember, it includes a person who becomes borrower of the securitization company. So once the asset is transferred to the securitized company, the borrower who was a borrower to the bank will now become a borrower to the securitized company. Remember, that is the meaning of this definition, includes. So the same borrower will now be the borrower for the asset reconstruction company. And he will not remain a borrower for the bank because bank has transferred that bad loan to the ARC. So a borrower cannot be a borrower to two institutions. Remember, you can be a borrower to only one institution. Yes, Sumit, why not? It could be a joint business venture. That's more of a commercial business venture by the two banks. So what type of loans are covered? Financial assistance are covered. The same definition. Debt secured by mortgage or charge on immovable property. Very simple definition. Or debt secured by mortgage or charge hypothecation of pledge of movable property. So mortgage or charge or hypothecation. I'm not going into the technicalities of what is the difference between hypothecation or pledge, because these are all being covered into your inter exams. And hypothecation is only of movable property, while charge is created of movable property, immovable property. Then any right or interest in a security underlying a debt. Now, what does this mean? Security means any of the asset. Collateral security. So it is not the primary security, but that collateral security has been given as a security for a loan taken by the borrower. So to that extent, I will have my right or interest in that particular property also. Beneficial interest in a debt in a property, whether movable or immovable. So let's say if a property has been given as a security against a loan, and on that property, there is some earning out of rent, so that the bank will have a beneficial interest on that rent also. because that property has been given as a security. So that is the meaning of beneficial interest in a property when it has been given as a security for a debt. So I hope things are cleared. A debt secured by movable property, immovable property, right or interest in a security underlying a debt, beneficial interest in property when it is given against a debt. Then further beneficial interest in any intangible asset, because that intangible asset might be given on royalty. So that royalty income will create a beneficial interest. Right? So beneficial interest in both the tangible asset as well as intangible asset. And a contract which secures the obligation to pay any unpaid portion of the purchase price of such asset, or an obligation incurred or credit otherwise provided to enable the borrower to acquire such intangible asset. So that means if you have entered into a hire purchase contract, lease contract, or any other contract which ensures that that contract is able to pay the unpaid portion of any purchase price of that particular asset, that is also covered as a financial asset. And finally, it includes the financial assistance, which itself means a financial asset. So remember what we have to remember by, for exam purpose, very important definition of financial asset. So debt secured, right or interest, beneficial interest, a contract, any third party extended contract which will ensure repayment of a loan, or which ensures that if that amount is not paid, I will be liable to pay that unpaid portion of that particular part of that loan. So if there is any contract, third party contract entered, so that is also covered under financial asset. And finally, the word simple, it includes financial assistance also. Very important, friends. An asset which is not a financial asset cannot be securitized. Which simply means unsecured loan cannot be securitized. They cannot be securitized. Who has got the power to go through this mode of ARC, selling the bad loans? Secured creditor. So normally secured creditor will consist of what? Any bank or financial institution or any consortium or group of banks. Consortium or group of banks. Remember this word, consortium or group of banks. Holding any right, title, or interest upon any tangible or intangible asset. Right? So consortium or group, remember the word consortium or group, it could be multiple banking. So consortium where 3 banks, 4 banks, 5 banks come together, where one bank takes the role of a lead bank. That means the one bank will execute all the documents on behalf of the other banks and will take the lead in all the compliances by the borrower. While in multiple banking, each bank will execute their own document. So it could be any bank. Remember, it could be debenture trustee. And secured creditor will also include the ARC, because normally the origination of secured creditor is in the form of a bank. But when that loan is transferred to the ARC, that ARC will also be treated as secured creditor, though it is not originated the transaction. Sumit, nowhere it has been mentioned whether it's purely a financial lease. But what I can understand that financial lease is in the structure of a loan, because operating lease is normally for use of an asset on a daily basis. Let's say a car taken on rent for a day. Now that cannot be treated as a debt, a financial debt. Remember, so you pay a rent to the mandap keeper, the tent house. That is an operating lease, right? So that cannot be covered. Here. And at last, secured creditor will also mean any other trustee holding securities on behalf of bank in whose favor security interest has been created. So the whole concept of secured creditor is any person who has that security, who has got the right to enforce that security, will be known as secured creditor. QIB, qualified institutional buyers. Where will they come into picture? As I mentioned, they will come into picture when the ARC or the trust is raising funds. So it could be another financial institution, it could be banks, it could be other ARCs also, it could be state financial corporations also. So there are many ARCs. It could be non-institutional investors specified by RBI. There could be asset management companies, by mutual funds. There could be state industrial development corporation, SIDC. There could be insurance companies. There could be foreign institutional investors. They are the people who would be willing to invest in ARCs. Those who cannot directly give loan in the market, normally they come in the form of ARC and try to take interest in the economy of this country. So what is the limitation if you can raise funds only from QIB? It could be explained from this particular example that ARC cannot raise funds from investor which is not a qualified buyer. That means if a manufacturing company is likely to invest surplus cash by investing in the ARC, no, it cannot do so. So if Reliance has surplus money, TCS, Infosys have surplus money, and they want to invest that money into ARC, they are not allowed. Though Infosys might be having, crores of rupees, and then they want to lend money to the banking world, they cannot do so. Securitization, as I've explained, the process of acquiring financial assets from the originator by raising of funds by such asset reconstruction company from qualified buyers. They are termed as securitization. That is termed as securitization. Now, last of the definition, friends, important part. As I mentioned that the Sarfasi Act covers three angles: securitization, reconstruction, and enforcement of security interest. And enforcement of security interest. Now, security interest means what? See, security, as I mentioned in the first initial part of the lecture, security means any asset which has been given as a security in the form of movable property, immovable property. So I have an interest, the bank has an interest in that security. That means I have a right, I have a title, because that security has been given as an additional security or a primary security. So it can be in the form of what? A mortgage, charge, hypothecation, assignment on intangible asset. Either that tangible asset can be retained by the secured creditor, or it could be given on hire, financial lease, which further creates an obligation to pay any unpaid portion of the purchase price of the asset. So that particular asset might have been given on a lease, but then that will ensure me that in case of non-payment of the purchase price of that asset, an obligation is casted to that particular person to repay that amount. Or such right, title, interest on any intangible asset. Two things, remember, security interest first is on the tangible, second is on the intangible part. So tangible, which is retained, so that property lies with me, that is retained, or that property has been given to third party also on rent or any other way, but that ensures, if there is a default, that I can recover the unpaid portion from that particular hire purchase agreement. Same way, right and title on the intangible property. So that means what I can understand, in case it is a company, remember, charge should be created. So here are a few questions for you, friends, and let me see whether you are able to catch the trick. No, Sumit, no limit. Okay, so the question goes like this. Akash Limited has issued listed bond 5 years ago, which is due to be redeemed in the current year, what, 50 crore. The projected cash flows and profitability of the company seems inadequate to repay the bond. Inadequate to repay the bond. Cloud Limited holds bonds worth 20 crores and wants to explore his option under the SARFAESI Act. Please advise Cloud Limited for the remedy available. Remedy available. So can Cloud Limited explore the option of SARFAESI? Remember, for trigger of SARFAESI, there has to be a loan, right? A debt, to be more technically correct. There has to be a debt. There has to be a default. In case it is a bank, NPA. If it is not a bank, then a notice for 90 days has to be given. Remember? By whom? By the debenture trustee. By the debenture trustee. So here, if that is coming for your advice, what advice would you give? That please give a notice to the company, notice to be given by that debenture trustee or the bond trustee after 90 days. And then if that amount is not repaid, then you can take the action under SARFAESI Act. But before that, you cannot take action. Is it clear? Now, please don't get confused between the amount part 50, 20, because 50 crores is the total amount which has been raised and this company only holds 20 crores. It is immaterial. It has never been mentioned in this whole particular process that you should hold a minimum this much percentage, then only you can raise the demand notice. No. If there's a default by to any of one of the borrowers, you can take action. So I hope this one question is again clarifying your doubts, bringing more conceptual clarity. Okay, so I'm solving this question again. I hope you got the previous question clear. And I hope you'll get this one clear too. If you have any doubts regarding the question, please keep raising your process in your mind. So the question is, Nationalized Bank had provided a term 20 crore to All Well Pharma Limited at a rate of 12% per annum. Principal point is payable in equal half yearly installment of 2 crores in 5 years. Good. The loan is fully secured. Very important. You need to highlight these terms, questions, terms in the question. Fully secured. So FASI can apply. Company was regular in paying 3 half-yearly installment along with interest during the first 2 years. Good. Due to recession, the increased competition, the price of the manufactured product had fallen down. Consequently, company had to close down the plant. Hence, the company failed to pay fourth installment, but it paid the interest when it was due. Good. After a period of 2 months from the due date of the loan, the bank decided to sell the loan to ARC. So that means when the loan became due after that due date, after 2 months, the bank decided to sell the loan to ARC. Good. Why not? It also decided to sell a loan of 50 lakhs given to a farmer, which is secured against agricultural land. That I will explain separately because I have not covered that. The bank manager comes to Vaibhav and seeks advice from Vaibhav. So what would Vaibhav say? What would Vaibhav reply? Friends, let us again break down. Is there a debt? Yes. Second question. Is it secured? Yes. Third question. Is there a default? Yes. Fourth question. Is it been termed as an NPA? Has it been qualified as an NPA? Can you see anywhere? No. For NPA, 90 days, while after a period of 2 months, it wants to sell the loan to ARC after a period of 2 months, which is not allowed. Therefore, what would Vaibhav do? He would tell the manager, please wait, have patience. And as we all understand, patience is key to our profession also. So have patience, wait for another 1 month. Thereafter, classify the account as NPA and take action. What about agricultural land, sir? Agricultural land are out of purview of SARFAESI. Agricultural land are out of purview of SARFAESI section 31. Section 31. So now with the conceptual clarity on the back of your mind, let us move ahead to the respective process and direct questions which could be asked in the exams on the SARFAESI Act. First direct question which can come in the exam or multiple choice question or some situation based scenario. What are the conditions of registrations of ARC? Conditions of registration for ARC section 3. So any company which wants to start the operation of ARC first should obtain a certificate of registration under this section. From whom? RBI. From whom? The RBI. And it should have a net owned funds of not less than 100 crore or such higher amount as the RBI may specify, which today is 15% of the financial asset. So remember, first it has to have a certificate and with a net owned fund of 100 crore. Who would put in that 100 crore? Sponsors. Remember, the word sponsor will come into the picture. They will put in 100 crore. Or if 15% of the financial asset. And what does net owned fund means? Please go to the RBI Act for reference of net owned fund for that calculation part. And logically, we are all students of CA background, so we know that net owned fund would normally be equal to your net worth, right? So once you have that 100 crore fund, go to RBI, apply, get a certificate of registration. And when you apply to RBI, you have to ensure the following conditions. You need to tell that the ARC has not incurred losses any of the 3 preceding financial years. So if you have already a running business, you need to tell that I have not incurred any loss. Or if you are going for renewal of the registration, you have to tell that I have not incurred any loss. And that the ARC has made adequate arrangements for realization of the financial asset acquired for the purpose of securitization and shall be able to pay periodical returns to the qualified institutional buyers. Because finally, the ARC is raising fund from QIB. They need to repay that amount to QIB. So they need to ensure that, yes, we will be able to pay that amount to QIB. So your process should be set in that I have got a good team, I have got a background, I have managed so much of assets, and I am able to operate and I am able to reconstruct all of business. So you have to prove that. And that the directors of the ARC have required qualification in the respective matters related to finance, securitization, and reconstruction. And obviously, the directors have not been convicted of any offense involving moral turpitude. And that the person who has given that contribution of 100 crores of net owned funds is a proper and fit person, and the ARC is complying with the prudential norms of classifying the account, and the ARC has complied with one or more conditions specified in the guidelines issued above. So remember, 4-mark direct question. 4-mark direct question. First is they need to get a certificate and have an own net owned fund. And the following conditions, 6 conditions, remember. 2 related to the directors. 1 related to the sponsor. 1 related to the prudential norms. 1 related to the P&L. And 1 related to the arrangement. Wherever the notice will apply that you need to pay the outstanding amount. They cannot call for all total debt which has not been due. So they will only call for whatever has been due, the unpaid, the amount which was not paid. So once you get a certificate of registration that you are now ARC, to start a business, you need a prior approval. To start a business, you must have a prior approval. Or for doing subsequent action, you also need a prior approval. So once you register yourself as IRC, you've got the approval for the business part. But then if you want to have certain actions, if you want to take certain actions, you need a prior approval. So again, exam question, direct 4-mark, 3-mark question. If there is a change in the management, please take prior approval. Change of location of office, prior approval. Change in its name, prior approval. I mean, very simple. We all know that if these are the 3 situations, you need to take a prior approval logically without undergoing any respective section. And substantial change has been explained that it means change in the management by way of transfer of shares or change affecting the sponsorship in the company. That means one sponsor is transferring shares to another sponsor. For that, prior approval is required. Normally, questions are asked on this topic, that when will the certificate get cancelled? The certificate of registration will get cancelled. So it will get cancelled when you have ceased, when you have failed, when you fails to. 3 scenarios. What are the 3 scenarios? So when you cease to carry on the business of securitization, when you cease to receive any amount from the QIB, right? When you have failed to comply with the conditions of certificate of registration, then when you fail to fulfill the conditions referred to in clause A to a G, 5, 6 conditions which we have just seen, directors, sponsors, profit making, arrangement. Then you have failed to take a prior approval under 3 of the scenarios. And at last, you have failed to maintain the account. So remember this, friends, C is has failed to or fails to. C is for the objective, failed to comply the conditions and fails to take prior approval. Further, if during an inspection of RBI, you submit or offer for inspection, fail to submit or offer for inspection of its books of account, or you fail to comply with any of the conditions issued by RBI, yes, opportunity will be given to be heard. So if your certificate gets cancelled, you have a right to appeal. And appeal where? That's a question. Against an order of RBI, appeal preferred to central government. Central government. So X Limited is an ARC, certificate of registration gets cancelled, state the authority which can cancel the registration. So is the authority to get cancelled this registration, friends? The authority is none but RBI. And what is the right? Right is simple. Within 30 days, it can apply to central government. For against the order of the cancellation. Yes, can we have a simple yes? of till now, whatever we have understood, discussed, has gone into tangent, has not gone over your head or tangent to your head. And I hope things are getting clear. I think A is the only option, but A and B, either A and B. Both are the same thing. So there was some, I think, some mistake in the MCQ part. But anyway, it has obtained a certificate of registration. Right? Correct? So I think ₹100 crores. Keep on answering, friends. So if you're getting all the MCQs correct, that means you are somewhere following me. And don't unfollow the ICAI YouTube channel, because it has got in lot many things material along with this subject. I think there are so many other material which is stored for you. Do keep following the ICAI YouTube channel and all the social media channels of ICAI for all the latest updates. So I think again a common question which everybody can answer, all of the above. Before granting a certificate, the RBI shall satisfy that directors do they have the requisite qualification? Yes. Have the company complied with all the conditions? Yes. Whether the sponsor is a fit and proper person? Yes. So D, yes. We have just seen, I think we have studied this, a simple 30 days. So one of the following ground is not the criteria for cancellation of registration certificate of RSC. Remember, the question is not the criteria. One. So we have seen the criteria for cancellation. Have we seen the criteria? Remember the first word, ceases. Then we have seen fails, failed and fails to. So ceases, failed to and fails. Therefore, the correct answer is D. Appeal can be made to whom? I think this is now very clear to everyone. Central Government, Ministry of Finance. Ranveer is an asset reconstruction company. This company failed to comply with any direction issued by RBI under the Provision Act. What action will RBI take now? Failed to comply. RBI, can he say, Ranveer, don't be Jagga Jasoos? No, sorry. Ranveer is Singham. No. forgot. Anyway, cancellation of certificate. So this covers our basic understanding. Now we move on to the process of acquiring the financial asset from the banks by the ARC. How will they acquire? What is the process? How will they reconstruct? So we have 10 more sections, very important one, but having a good coverage of around next 30, 40, 35 slides. So after this section, we'll take a small break and then start with one of the major section. So what is the mode of acquiring? When the ARC will approach the bank, how will they acquire? So they will acquire by issuing debenture, bonds, and any security. As I mentioned, that they will not give cash, they will issue a instrument. As a consideration, remember. And by an agreement between the bank, company, bank, and institution, the asset will be transferred. Fine. So remember this part. By issuing a debenture, bond, any other security, the assets are transferred. What will happen subsequently when the assets get transferred? Initially, who is the lender? The bank. Once the assets are transferred, the lender will be the ARC. On such acquisition, the ARC will be deemed to be the lender. So that means now ARC will step into the shoes of the lender and he will be treated as one of the person who has given the loan to the borrower. So once he becomes the lender, then all subsequently rights, title, interest in that financial asset will switch on or be given to the ARC. So that means all the right, title, interest to the security which the borrower has given, that will now get transferred to the ARC. So vesting of all the right, title, or interest related to the said financial asset. So under section 5, if the bank is holding any right on any tangible or intangible asset to secure the payment of that unpaid portion of the purchase price of that such asset, or an obligation incurred, then such right, title, interest shall vest in the asset reconstruction company. So because of this transfer effect, transfer of the asset, then all contracts, agreements, power of attorneys, whatever has been executed between the borrower and the bank, which relates to that financial asset to which that bank is a party, that will now all stand in favor of the ARC. So by virtue of this particular section, everything which has been done by the bank will now be deemed to be done by the ARC, will get transferred to the ARC. And if there is any pending suit, legal proceedings, will be continued and they will not stop only by the virtue of the fact that, the assets have been transferred. If required, the mode of recovery we'll study later on that the mode of recovery is through the DRAT, Debt Recovery Tribunal. So once you acquire the financial asset, the ARC will have got the right to file a suit and application before the Debt Recovery Tribunal or the Appellate Tribunal. We'll see to that. So what could be the possible question in this particular part of Section 5? That first question, how the assets will be transferred. And then once the assets are transferred, acquired under Section 5, what are the subsequent things which are going to happen? Repercussions or impact of the transfer of the rights. Now, if the financial asset has been transferred and where there are multiple applications filed in front of DRT. DRT is an tribunal where we will file for recovery of debt. If an amount is due, then we can file a suit against that company, the Debt Recovery Tribunal. And if, let's say, there are multiple banks who have filed multiple applications at different Debt Recovery Tribunals. So let's say for Mumbai, it is Maharashtra, it is Mumbai. For Delhi, it is Delhi. For Rajasthan, it is Jaipur. Then there could be different Debt Recovery Tribunal which are taking action against the company. And now we have only the ARC who has taken the loan from all the banks. So the ARC can tell the Debt Recovery Tribunal that please transfer all the cases at one DRT, because now I am the single lender. So instead of multiple banks giving loan to that company at different states, I am the sole lender. So please transfer this application file to the jurisdiction of the tribunal where I run my business. So here we take a short break, and thereafter we'll start with section number 6 and then section number 9, which is one of the important parts, 9, 13, 15. 3 important sections to be covered now. 9, 13, 15. Right, friends? So after a short break, we're going to start with 9, 13, 15. So once the asset has been acquired by the ARC, the asset has been given to the ARC now. So this has to be given, this information has to be given to the borrower as well as the surety, the obligor. They are the obligor. That the asset, the financial asset or the debt from the point of the borrower has been assigned or handed over to the ARC. And the borrower need to make the payment to the ARC in discharge of the obligations in relation to that financial asset. So that notice, the responsibility of giving this notice has been casted on the bank and the financial institution. This is a very important section, friends, where the steps to be taken for asset reconstruction. So we have covered one part, securitization. Now we move on to the next part, reconstruction. 5-mark exam question, 5-mark exam question directly from this section 9. That what are the steps to be taken by the ARC for the reconstruction of the asset? Steps to be taken by the ARC for the reconstruction of the asset. And the steps are very logical, very logical. No complications involved. And as a chartered accountant also, you would appreciate that, yes, as to revamp the business, to restructure the business, to align the business, what steps could be taken? The first step, the proper management of the business of the borrower by changing or takeover of the management of the business of the borrower. Now, that is the first step which you can take. Change the management. Say that you are not performing efficiently. I will take over the business and perform the job. Can the ARC do that? Why not? Can the ARC run the business? As I said, ARC comprises of people having technical expertise, specialized people having good background, financial background, knowledge, background of the particular industry. So you'll find that there are a lot of specific ARC for construction business, ARC for textile business. So they know, they have their requisite experience to run that business. They have people on their board who can advise and run that business. So they can do that. Normally, it is not seen that ARC takes over the business. Normally. But then that is one of the measures which has been given in the Act. The second, it could be sale or lease of part of our whole of the business. So they can do that. They can tell that, we won't want to carry on this particular business. We want to sell that business. That can be a possibility. Whole of the business or part of business, or they can give the business on lease to someone else. They can reschedule the payment of loan right from 2 years, 3 years to they can reschedule it for 5 years, 7 years, 10 years. Then they can always go for enforcement of security interest, which we'll see in section 13. They can go for a one-time settlement. Okay, let's settle off the loan. Settlement of dues payable by the borrower. They can take possession of the secured assets again as per the provisions of the Act, which we'll see. Or they can convert the debt into equity also. So they can take a controlling stake over the company. So if you want to learn, one is by management. Then second is rescheduling or settlement of loan. Then as per Act, whatever other possible measures are taken, either enforcement or taking possession of the secured assets. Conversion of debt into equity or sale or lease of part of the business. So 7 steps the ARC can take for reconstruction. Very self-explanatory. Just learn that. I'm sure if luck is in your favor, 5-mark question. Apart from the major reconstruction of the business, ARC has been given that they can perform some other actions also. That is 3 things. As a receiver, as an agent or as a manager, RAM. So they can act as a receiver if so appointed by the court. That means they will try to realize the assets. So that's the meaning of receiver. Liquidator and receiver are two different things, remember. Then they can work as an agent for recovering their dues. That means the bank can appoint the ARC for recovery of the amount from the borrower for an agreed fees. Or they can be appointed as a person to manage the business. As I said, ARC could have a technical expertise also to run the business. So they could be appointed to manage the secured assets, the position which has been taken over by the banks. So three other functions apart from reconstruction. So apart from RAM, reconstruction, they can perform the job of RAM or RAM. If they want to perform other functions, answer is no, until unless they take a prior approval of RBI. Fine, that's always possible. If there is a dispute between the bank, the ARC, or the financial institution, that will be settled as per the Arbitration and Conciliation Act. Friends, again, very important, as a chartered accountant, prospective chartered accountant, let me tell you the prospective opportunities out here. SARFAESI is a very good opportunity along with IBC and along with one of the important things which are going to gain importance in times to come is about arbitration, mediation, and conciliation. As the number of disputes are rising day by day, that's the biggest problem happening across the world. It's not about disputes in India, it's about dispute across the border. So if the number of disputes arises, there will be need of arbitration and conciliation, and there as a chartered accountant, we have a big prospect. One direct question again could come from this particular part is the power of RBI. The powers of RBI in terms of giving directions to ARC. So the RBI may give direction with respect to the type of financial asset which the ARC can take over. The value, total value of financial assets which may be acquired by ARC, or they can also determine the fees and other charges which could be charged by the ARC. How the security receipt could be transferred to qualified buyers. They can also call for statement and information, that's always there with RBI. They can carry out the audit and inspection of ARC, and that could be done by the RBI officers, inspectors, or they can be outsourced to CA firms also. And if during the course of inspection and audit, they find that the business is being carried on with the detrimental to public interest, they can, make an order by removing the chairman or director, then appoint an observer or officer of their own from their own list. So that is these are the powers given to the RBI. In general, you have to remember it because possibility may come in that a direct question could be asked. So don't want to take risks. If you are covering this whole act, friends, I would suggest that cover it throughout. Don't do it in tidbits. Because again, as I said, small act covering a very specific area, not much of complications, and specific sections are most likely to be asked. But don't ignore these small sections. So you have to cover 20 sections. Please concentrate on those 20 sections to secure at least 5 marks. The last part of this particular act. The last part of this particular act is enforcement of security interest. Enforcement of security interest. So we have covered 2 parts. First part, securitization. Second part, reconstruction. Section 9, 6 steps, 7 steps for reconstruction of business. Remember that. So third part comes in is about enforcement. Now, what does enforcement means? So I have a security, ARC has a security, or the bank has got a security. Both of them. We're not talking of the ARC now. The role of ARC gets over under the reconstruction. Now we are talking in general enforcement, which can apply to both the banks as well as the ARC. So if they've got a security, how can they enforce that? Normally it has been seen, before this act came into picture, before 2002. The banks face a lot of problems in recovering their dues by selling off the securities given by the borrower. And the borrower knew that though they have given the security, but it is not easy for the bank to sell off those assets. And it took years and years for the bank to recover their amount. And therefore, this act was introduced for the banking, which gave them certain rights to recover the amount without the intervention of the court or the tribunal. And before this particular act, what used to happen? Every borrower used to bring a stay order for sale of their securities, the assets which were given on security, the land, and banks were helpless in selling off those securities. But by virtue of this particular section 13, which gives a lot of power to the banks, they can sell the assets of the borrower without taking permission from the courts. And that is why all the borrowers today are worried about this particular section, and thereafter the IBC part. So if you read newspapers, friends, if you read newspapers, you will see a big ads coming out from the banks mentioning the name of the borrower, the land, the value of the security, and they mention that these are available for sale with the reserve price. Big ads are now coming out in newspaper daily. Every bank is coming out with a lot of details that these securities are now under their position. They want to sell off these assets. These were not seen about 4, 5, 6, 7 years back, but these are now common in everyday newspaper. So when the borrower makes a default in the payment of debt under any security arrangement, and when the account has been classified as an NPA, then the secured creditor may require the borrower by notice in writing to discharge in full his liability to the secured creditor within 60 days from the date of notice, failing which the security will be entitled to exercise all of the rights under section 13(4). This is known as 13(2) notice. Very important. A dreadful notice in the world of banking for the borrower's angle. Remember, every borrower is aware of this section 13(2) notice, where 60 days time is given to the borrower to repay the amount. If it is not given, then 13(4) could be invoked, and then 13(4), if invoked, then all the assets could go in the possession of the bank or the ARC. So if it is a bank, then NPA. If it is not a bank, if it is for the company which has raised funds to debt securities, then the debenture trustee shall be entitled to enforce the security interest. And accordingly, same process would be followed. So remember, 13(2) notice in writing has to be given before invoking 13(4). Important part, remember, from exam perspective, a lot of questions come from this particular act section. The content of the notice should mention the amount, it should mention the amount payable by the borrower and the list of secured assets intended to be enforced by the secured creditor in the event of non-payment. Yes, very correct, Sumit. as you mentioned, that the banks today either have a right, either they can go through SARFAESI, or either they can go through IBC. Or third is they can sell the loan to the ARC. Three options. SARFAESI, sell the loan to ARC, or approach IBC. Is it clear? So as a consultant today, you become consultant and then give consult to banks, or you also advise to your client who is in distress that what could be the possible things which actions can be taken against that company. Then as a borrower, what I have to do? Borrower's obligation. Borrower action. Either he repay the amount, good, or he make representation or objection. He objects to the 13.2 notice that yes, 13.2 notice is wrong. I have not defaulted. I am defaulted because of A reason, Y reason, B reason, C reason, and there's no such default. And this security, whatever security which you have offered has some defaults, has some problem. The document has some problem. You cannot enforce that. So make representation or objection, where the creditor has to work upon that objection. What is the representation? And they can reject the objection within 15 days giving reasons. Please note this. Important from exam perspective, or total case study could come where days could be given, and you need to take care of this, that the bank have to reply. Bank have to reply within 15 days in writing, giving reasons for rejection. And if they don't do it, they lose the right of invoking section 13.4. They lose the right of invoking section 13.4. Is it clear, friends? Are you getting a holistic picture of what we are talking about, friends? SARFAESI, a mode of recovery for the bank, seamless process without any hassle. Though obviously it has some hurdles. It's not that very easy, but a lot of hurdles. But then at least in comparison to the previous years, process has got much in favor of the banks. And if the borrower does not repays it, does not replies, the creditor can enforce security interest. (13.4) exam question again. 13.4 exam question. In case of failure to discharge the liability, that means the borrower is not able to pay the last point, not repaid. Then, what are the steps the bank can take, ARC can take, whoever? Take possession of the secured assets. That means they will go and tell, we are the owners now. Please set yourself aside and hand over the assets to us. First, possession of secured assets. Management of the business of the borrower. That means now everything will lie with the borrower, bank, including the right to transfer by way of lease, assignment, or sale of realizing the secured asset. Provided this takeover of the management is only possible when the substantial part of the business is held as security for the debt. So that means, let's say a company has got two businesses. Company has got two businesses. Business 1, business 2. And only business 1 has been given as a security to the bank. And this comprises only 30% of the overall business. They cannot take over company A. They cannot take over the management of the business of company A. Or even if they want to take over the management of business A, they cannot sell it. They cannot sell the company by way of lease assignment, because the second business comprises about 70%, which is not being given as a security. Provided further, whether management of the whole of the business or part of the business is severable, the secured creditor shall take over the management of the business, which is relatable to the security of the debt. That means, as I said, if company A has business 1 and business 2, and they can be separated, they are severable. That means, in that case, the management of only B1 would be taken over by the ARC or the bank, and they will not take over the management of B2. So if Reliance has multiple business, or if Birla Group has multiple business, or if the Jindals have multiple business, if the Munjals have multiple business, Bajaj have multiple businesses, there are so many examples which we can create, though these are examples of good companies. So 2 points: take position of the secured asset, take position of the management. Now, this could be a separate exam question, that what are the points to be considered when taking over the management of the business of the borrower. They can appoint any person referred to as a manager to manage the secured asset. So they can appoint a person who will sit there and take care of the position of the asset. And required at any time by notice in writing any person who has acquired any of the secured assets from the borrower and from whom any money is due or may become due to the borrower, to pay the secured creditor so much of the money as is sufficient to pay the secured debt. That means, let's say example, Abhishek Limited sells some of the secured assets to Ash Limited. Those assets which have been given to bank. Now, bank takes over the assets of the Abhishek Limited. Now, when Ash Limited has taken over certain assets, some amount is still due to be paid to Abhishek Limited for these assets. So when the bank takes over the secured assets, then whatever amount is due by Ash Limited to Abhishek Limited will not be paid to Abhishek, but then to be paid directly to the bank. I hope you are getting my point. So that means they acquire the right on those assets, and any assets, if they have been transferred, so if any amount is due on that particular asset, that right will now get, the right will be transferred to the borrower, not to the company. Now, how this process will take, when they want to sell the asset after the position has been held by the bank. So they will issue an auction notice normally. That is the process. An auction notice is released in the newspapers that this particular land is available for sale, and this is the minimum reserve price. So if anybody wants to bid for that, there's a link, there's a website through which the tendering could be done. So is it necessary that all the assets could be sold off? No, not necessary. So some assets might not be sold because the reserve price is too high. There's no buyer. So where it happens in the sale of immovable property for which a reserve price has been specified has been postponed for want of a bid of an amount not less than such reserve price. That means the assets could not be sold off even after revising the bid price. Then the secured creditor itself can buy that property. The secured creditor can itself buy that property. That means it can bid for that particular property. Not buy, not compulsory, but it can bid for that particular property. So subsequently, at whatever price the secured creditor has bought that particular asset, that amount will be adjusted. That amount will be adjusted from the outstanding dues of the borrower, and the balance amount could be further claimed. Now, during this whole process, we know expenses could be incurred. So what is the mechanism of distribution of that proceeds which will be realized from the sale of asset? So where any action has been taken against a borrower, all costs, charge, expenses have been properly incurred shall be recoverable from the borrower, and the money which is received by the secured creditor shall first be applied in payment of such costs, charge and expenses, and secondly in discharge of the dues of the secured creditor and residue of the amount so as received shall be paid to the person entitled. So for example, 20 lakhs is the amount realized and 2% is the expenses. So that means $40,000 expense. So 19,60,000 will be adjusted against the outstanding loan. If the outstanding loan is about 30 lakhs, so 19,60,000 will be adjusted against this 30 lakhs, not 20 lakhs, because 40,000 has been incurred as expense. So if the amount outstanding due is 18 lakhs, 18 lakhs will be adjusted and 1,60,000 will be paid back to the borrower. So remember, section 13 is a very big section, friends. So first we need to remember the 13.2 notice, very important, 13.2 notice. The contents of the notice, subsequent action of the notice, and then steps taken under 13.4. Steps taken under 13.4. If you have any questions coming up in your mind, please raise. Do I assume that there's a very much conceptual clarity of the section? 13, when does it apply? Remember, 13 applies for enforcement of security interest. Who will take action? It can be anybody, bank, ERC, debenture holders, any financial institution. Okay, so let's have these questions, friends. A Limited defaulted in the payment of term loan taken from a nationalized bank. Again, security created its first charge on its land and building. Remember, first charge. The bank classified the loan as NPA. Then it issued notice pursuant to Section 13 within 60 days. The company objected for full settlement and the time limit for settlement. The bank did not respond to the objection of the company. In light of the provision, decide whether the objection is valid, whether the bank has to respond to the objection of the company, whether the bank has the right to enforce the security interest without intervention of the court. So my answer to the first part, objection of the company is valid? Yes. So they are asking for time for settlement? Yes. Second, whether bank has to respond to the objection? Yes. Within 15 days, in writing, rejecting the objection. And third, whether the bank has the right to enforce the security interest. They had the right, but because they have not responded within 15 days, they lose the right. Is it clear, friends? Is it clear? Payment of dues of the secured creditors, friends, as I explained, once you have issued Section 13(2) notice and you have taken the possession of the asset under 13(4), subsequent to that, the borrower comes and offers everything to the bank and says that I'm settling your amount as agreed. Then what can happen? So when the amount of dues is tendered to the secured creditor anytime before the date of publication, notice for public auction, then the secured asset shall not be transferred by way of lease, assignment, or sale. They will not go ahead. Or if the step has been taken for publication, no further step shall be taken by the such secured creditor. So even if the publication has been done, further actions cannot be taken by the secured creditor because the amount has been settled. So this is again an exam question, short, but very simple one. Now, as I've explained, there's a consortium finance, there's multiple banking. And in consortium finance or multiple banking, one bank has issued 13(2) notice, other bank has not. Will one bank get the right of possession of the asset? So in case of joint financing, no secured creditor shall be entitled to exercise any rights conferred on him under this subsection 4, unless such right is agreed upon by secured creditors not representing not less than 60% in value of the amounts outstanding as on the record date. And what is the record date? The secured creditors coming together will decide the date, and that particular date should be decided by not less than 3/4 in value of the amount outstanding on such date. So deciding the date will be based on the 3/4 in value of the secured creditors. And on that record date, not less than 60% should allow for taking possession of the asset under section 13(4). So this could be again a detailed case study. A scenario-based question could be framed purely based on calculation. It's more of maths rather than any technical part of the case law. More mathematical things. So once they have to come at a particular agreement on the record date, and based on the record date calculation, voting will be done. And voting, if more than 60%, then the action under 13(4) could be taken by any one of the creditors. But if not agreed, then no creditor can take action under 13(4). So in case of joint financing, for example, a company has taken a loan of 20 crore against property from Bank A and 8 crore Bank B and 4 crore from Bank C. Then on default, what are the consequences if Bank A wants to use first method and Bank B wants to use second method for enforcing security interest? So, banks would have a different opinion on enforcing security interest. Some would say that I want to sell, some would say I want to lease or whatever. So then voting will be held. So for any bank to take any action, they would need at least 60% of the vote from all the banks coming together. And that 60% voting calculation will be based for a record date on which that voting percent would be calculated. Right? So in 13, there are a lot of ifs and thens, a lot of scenarios. Primarily it is enforcement, but it's a big section and very important one. So in case the company secured creditor who opts for realizing his security instead of relinquishing his security and proving his debt under proviso of corresponding section 325 of the Companies Act, then we retain the sale proceeds of his secured assets after depositing the workman due. So we have seen in case of winding up under section 326, the workman dues has to be paid. So if the bank is selling the assets, then as per section 326, the workman dues has to be paid. So first it will be paid and thereafter the amount will be retained in setting of the bank dues. So in case of winding up, if the company is under winding up, then this provision will be coming into action. So we have seen winding up also, so we can always relate to it. Now, a natural question comes in. Can the secured creditor recover the whole amount of outstanding dues from the sale of asset under enforcement? The answer is yes and no. So let's say the loan outstanding is 1 crore, and if they are able to realize more than 1 crore, well and good. Things are on happy note. But what if the amount realized after enforcement is less than the amount which is due, that is less than 1 crore? So if the amount realized is, let's say 70 crores, 70 lakhs, 75 lakhs, 80 lakhs, then what is the further action which can be taken by the secured creditor? Further action which can be taken by the secured creditor. So this is another exam question. Is that the end of the story, friends? No, that is not the end of the story. Where the secured creditor are not fully satisfied with the sale proceeds of the secured assets, the secured creditor may file an application in the form and manner as prescribed to the DRT for recovery of the balance amount. So now they will approach the DRT for recovery of the balance amount, and the secured creditor shall be entitled to proceed against the guarantors or also sell the pledged assets. So they can approach the guarantors and ask and tell them to pay that particular amount. Now, can they approach the guarantor without enforcement of security interest? The answer is yes, without first taking any of the measures specified in clause A to D. So when the default happens, they can always tell the guarantor that you also need to pay the amount, please pay the amount. So that means they will work in conjunction. They will go hand in hand. Right? So the question which could be framed in the exam is that, what if the amount realized after enforcement is not enough? Or what if the borrower is not fully paying the amount? Can the bankers institution approach the guarantors? So let's have one example on the calculation part also, so that now picture becomes more clear. If the bank takes possession of one property, not position, but possession of one property, and tries to sell it via auction, the fees of the auction is 2% of realization. The cost of publication newspaper is 10,000. Calculation of A. 1.9 minus 2%. Sorry, minus 10,000. What can the bank do if the views are not fully satisfied? Approach DRT. What if the property is sold at 2.25? So as I said, if the amount realized is more, whatever the balance is left, that will be handed over to the borrower. What if the borrower repay the whole amount anytime before the publication of ad? Then the secured creditor should not take any action for sale, lease, assignment of the said property. Can borrower sell the secured asset after receiving the notice of transfer of that asset by the creditor? Answer is no. If that asset is sold, if any amount which has to be realized, that amount will be directly given to the secured creditor. See, when you want to take over the asset, I think you will face lots of resistance from the borrower itself or whoever is holding the position of that particular security. So in that case, a provision has been introduced to support the process, and they can seek support of the district magistrate or the chief metropolitan magistrate to carry on the proceedings or take possession of such assets. The last of the section, friends, very important again. When you want to take over the management of the business, so a process has to be followed. So either the ARC, if it is taking the management of the business under section 9 or 13.4. So what will the borrower do? Again, exam question, section 15, exam question. So first step, they will publish a notice in newspaper that they want to appoint, if it is a company, directors or administrator of the business. So publication will come that new directors are to be required. So what will happen once the notice is issued? Then all the existing directors will lose their control and they will deem to have vacated their offices. Deemed to have vacated their offices. So what could be the possible, effect on all the contracts which have been entered by the management, the previous management? So any contract of management between the borrower and any director or manager thereof holding such offices shall deem to be terminated. And all the properties and effects of the business of the borrower shall deem to be in custody of the directors, the new directors from the date of publication. So it's more of like the new directors will take over the control over the custody of the assets and then carry on the business. And they will be entitled to take all the actions. They will be entitled to exercise all the powers as the case may be of the person exercising powers of superintendence, direction and control of the business of the borrower. And if such powers are derived from the memorandum, then they will deem to be derived from the memorandum. So in case it is a company, so it will be derived from the memorandum, or if it is not a company, by virtue of this section, all powers will now lie on the newly appointed administrator. So the old contracts will be terminated. The new appointed directors will take over the control of the assets. And thereafter, all the powers of control direction will lie on the new team. This is again an exam question, this particular slide, please remember. Can a shareholder take any action? Then, if the new management has been appointed, it shall not be lawful for the shareholders of the company to nominate any other person as to be director. No resolution can be passed at the meeting of the company unless approved by the secured creditor. No winding up can be proceeded without the consent of the secured creditor. So shareholder, they cannot appoint anyone. No meeting, no resolution can be passed unless approved by secured creditor, and no winding up. Very important exam question. Restrictions on any approval by the shareholders. So 3 restrictions on approval of the shareholders. Now, it may happen, the secured creditor is running the business and the old management comes in and repays the whole amount. Or during the running of the business, the secured creditor is able to recover the whole outstanding. Then it is the liability of the secured creditor to hand over the business, to restore the management of the business to the old borrower, to the old management. So that's a very big risky thing. But then in due course, what has happened? they have converted their loan into equity. So they are now the new owners. So the old owners have gone because the debt has been converted into equity, therefore acquiring controlling interest in the business. Then restoration to the old management may not be possible. So again, this is an exam question, friends. Can management be restored? Yes, it can be restored once the amount is totally paid in whole. But if debt is converted into equity and they acquire a controlling stake by the secured creditor, they cannot do so. So during that period, the directors are not working, the old management is not working. Can they call for any compensation? The answer is no. For loss of office because of this SARFAESI action, the old directors will not be given any remuneration or compensation. Friends, I hope this section is again getting clearer. Section 15. 15 talks about, remember, management and takeover manner and the ways of taking over the management. Yes, Weber. Yes, Weber. Correctly pointed out. So 13, takeover. Big section. 15, takeover of the management of the business. 13 is taking over the asset. Remember, taking over the asset along with the management. Two things. So if there is a takeover of the management, 15 has to be followed. So 15 is linked to 13 and 9. Which of the following is not a security interest? So let us see which of the following is a security interest. So as I mentioned, that agricultural land does not fall under this purview. So A option. A option. Rest, there is no such restriction. So option A. Which of the following is not the precondition? So which of the following is precondition for enforcement of security interest? There should be default? Yes. NPA? Yes. Notice in writing? Yes. There is no mandatory requirement. Yes, there is a mandatory requirement for a security agreement. So this is the correct answer. The management of the business is taken over by the secured creditor. The secured creditor may appoint as many persons as they think fit to be the option A. Small angle, friends, DRT and DRAT. DRT is a recovery tribunal where any application which you have to file against any action under SARFAESI. So any person, including the borrower, agreed by any of the measures given in section 13.4 taken by the security creditor may make application within 45 days. So if 13.4 notice has been issued, action has been taken, then I can apply to DRT within 45 days. Remember, if the communication of reason to the borrower by the secured creditor for not having accepted his representation or the likely action of the secured creditor shall not entitle the person to make an application. So that is very important to reply to the notice. The jurisdiction of DRT, where the cause of action, where the branch of the bank is situated, or where the secured asset is located, or where the branch is maintaining an account. That means it may be the place of business of the borrower, where the asset is located, or where the bank is maintaining the account. It could be any of the jurisdiction. So what can DRT decide? DRT can decide that the actions are not in accordance with the provisions, or they are in accordance with the provisions. So it can be two things, no or yes. If it is under 1, not in accordance with the provisions, then 13.4 is invalid. Restore the position of secured assets and pass any other direction. Obviously, very logical, because the order, the actions taken by bank is not correct. And if it is under 2, then whatever the bank has done, they will mark a seal on that. Very important, because as these are all proceedings which create value for the secured creditors. So it has been mentioned in the law that within 60 days, the application has to be disposed of, though it takes a lot of time again. Though it is mentioned 60 days, but then it goes beyond 60 days practically. But maximum, it cannot exceed 4 months. Maximum, it cannot exceed 4 months. Maximum, it cannot exceed 4 months. So minimum 60 days, maximum 4 months. If it is not done within 4 months also, we can give a request to the appellate tribunal. That means now we can go to DRAT. DRAT. So who can apply to DRT? Any person aggrieved by an order of DRT, 30 days from the date of receipt of order. But then the problem lies in that you have to deposit 50% of the amount debt due. And it can be reduced if the appellate tribunal agrees to that, but not less than 25% of the debt. So going to DRAT will make some revenue outflow, cash outflow from your pocket. So that is why it is better that things are get resolved at the DRT part. These are right. Rest of the MCQs are on a very easy note related to DRT and DRAT, not much of relevance for exam part, but as you can go through the respective provisions of the deadlines. I have already sent the material to the institute, and I hope just 1 second. Yeah, Arshad, just 1 second. You're talking about section 16. This one. Yeah, that exception is basically about, see, if any amount is due to that director, not because of the position of the director, but because he has supplied some money, has supplied some material services to the company, then in that case, that director will be eligible to recover that amount. Right? Not because of the loss of office, but because you are a supplier to the company by virtue of any business transaction, then you are eligible to get that amount. Is that clear, Harshad? So friends, I've already given this presentation to the institute, and I hope it has been uploaded to the portal, and you can go through those portal, and you can very well raise questions through the institute to me, and I'm sure I'll reply back as early as possible. But very exhaustive PPTs presentation, which will cover the major things which are asked in the exams along with the MCQ. Yes, Harshad, the amount is refundable. If the order is in your favor, the amount will be refunded. If the order is not in your favor, the amount could be adjusted. Okay, winding up is still pending. Okay, I'll do that, Harsha. The winding up PPT. I don't know. I thought that I have sent it, but if not, I'll do that. Right? So Sarfasi, just to recall, friends, just to wind up again, Sarfasi main sections. Securitization. I hope the process is clear. The initial part of the presentation, what is securitization, and then the administrative provisions of registration as a ARC, section 3, 4, 5, cancellation of registration for the ARC, some definitions, debt, default, security interest, what are those definitions. Then we move on to the reconstruction of the business, section 9, measures which can be taken by the ARC. That is important part. Then the functions of ARC, 9 and 10. Then directions of RBI, normal administrative section. Then major is 13 and 15. 13 and 15. 13 is about notices and enforcement of security interest. 15 is about management of the business. 16 again, loss of compensation, and then small sections of DRT and DRT could be covered. So right, friends, this completes our total. No, there is no such person, Arshad, as caveat. Caveat is something you should be aware. We are trying to make an application to everyone, to the court, that I'm taking over this asset. So if anybody has a problem, please let me know. That is a caveat. Otherwise, what happens that, as I said, there's a lot of intervention of the court. And when the borrower comes to know that the section 13 is being invoked, he can very well apply to the court that no action can be taken against that property. And then the court can give a stay order before Sarfasi notices are issued. So to avoid that, a caveat is filed by the borrower that I'm already doing this. Please don't stop me. Okay. So thank you, Chavi. Thank you, Harshad. Thank you, Shubham. Thank you, Sumit. So this completes our one part of the whole economics law. I'll be back with the next set and very important IBC law, where we'll have an exhaustive discussion on this newly framed law, and very interesting one. Yes, sir. Yes.